Looks very much like a human life cycle, right? The human life cycle is you're born, you grow up, you become a teenager, you're at the peak of your life, then you get middle age, and you get old, and then you go into decline and death. Companies go through the same life cycle.
Hmm.
Now, why do human beings need to be aware of where they are in the life cycle? Because you get constant physical and mental reminders of how old you are,
Hmm.
right? And the rule for human beings is as you get older, you got to accept the fact that you are older. There's some things you cannot do when you're 55 that you could do when you're 25. And if you try, bad things happen to you. Now,
Right.
companies have the same process. They age. There's nothing good or bad about it, but you have to accept where you are in the aging process and behave differently. Behave differently in terms of how you invest, how you finance yourself, how much you return to investors. Investors looking at companies have to take that into context. If you're buying a middle aged company, it's unreal to sit there and expect it to grow 30% a year and act like a
Hmm.
young company. You don't want it to. So
Hmm.
investors need to be aware. If you're managing the company and saying, what kind of skill set do I need to manage a company? Very different if you're looking at a young company as opposed to an older company. So, as with human beings, companies need to be aware of the aging process, adapt to it, and try to do their best to extend the aging process, make it work in their favor.
Welcome to Talking Billions. We talk about big ideas, big inspirations, big topics. We take on the hardest topic of all, money. How to make it, save it, keep it. But our conversations lead us to an even bigger question, what it means to live a rich life beyond money. My guests share their practices, principles, and evergreen wisdom. I'm your host, Bogumil Baranowski, author, TEDx speaker, and investment advisor to wealth creators with patient capital and an infinite investment horizon. I work with families and individuals who aspire to grow wealth over a lifetime and generations through disciplined, thoughtful investments in durable quality businesses, while giving money meaning. Join me on this quest to unearth and share the wisdom of the ages. Let me share with you the podcast program disclosure statement. Blue Infinitas Capital LLC is a registered investment advisor, and the opinions expressed by the firm's employees and podcast guests on this show are their own and do not reflect the opinions of Blue Infinitas Capital. All the statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. The information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. The information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance. None of what you're about to hear is investment advice. My guest today is Professor Aswath Damodaran. He teaches corporate finance and valuation at the Stern School of Business at NYU. He says that he is a teacher first, who also happens to love untangling the puzzles of corporate finance and valuation and writing about his experience. He believes that businesses, education, publishing, and financial services are all big, inefficiently run, and deserve to be disrupted. He believes he may not have the power to change the status quo in any of the three, but he can stir the pot. So let's stir the pot together today. How are you, Professor? Nice to see you.
I'm doing well. Thank you for having me.
Well, it's a real joy, and I mentioned to you that you might not know, but back in 2009, January, I was in New York at Goldman Sachs when you were giving a lecture. I wasn't working at Goldman. I was visiting Goldman at the time, and it was the time of a storm and chaos outside, and your lecture about valuations was a voice of reason in the middle of it all. So I have fond memories of those days.
In fact, I'm glad you started with that because I'd love to tell you that I felt self-assured in January 2009 and I knew what I was talking about. But the truth is, 2008 shook us all up, shook all of us, practitioners, academics. because it kind of went to the core of what we were, what we thought we knew about finance. And it said, maybe you don't know what you do. In fact, in October and November, I wrote a series of papers that I call my, doomsday papers, where essentially I said, what if there's no risk-free rate? I mean, we assume when we talk about investing, there's something that is risk-free. What if nothing is risk-free?
Right.
What if risk premiums change? What if this line between developed and emerging markets no longer exists? And it's a process that I repeat every time there's a crisis, because if you listen to the voices around you, it's so easy to get distracted and panicky. Sometimes it's good to go back to basics and say, what am I learning? How do I restructure what I already know based on what I've learned? I did during COVID as well. In fact, I kept a journal during COVID where every week I recorded in real time both what I was seeing and how I was feeling. The how I was feeling is critical, because after every crisis, there are books that come out of the crisis that are self-assured, right? That act like they knew what should be done in the first place. But the truth is, in the middle of the crisis, you really don't feel as self-assured. So I'm glad I wrote those pieces because they record for time, and I shared them on my blog so people knew how I felt. So I couldn't go back and erase history and say, I knew on March 23rd of 2020 that everything would turn around. No, I did not. In fact, the post I wrote that day was, is the world ending? I concluded that it was not, but it was, I mean, I had no sense of assurance that that was the bottom. So it's, I think, a good idea for investors to actually keep a journal when they feel shaken, write down what they feel, and then use that as a basis for rethinking what they think they already know.
I appreciate you saying that. I was writing every week to clients during that time of March 2020, which felt very different than 08, 09. And I was more experienced, but also I feel it was a different experience on many levels. I can't compare the two, although you could say, there's a market correction here and there, but a completely different backdrop. But to look back and read what I was thinking at the time, it's very, very helpful and very humbling, because looking back, we assume, of course, we knew that the help is coming. Of course, the recovery will come. We didn't know. And I was taking a lot of calls in March of 2020 from people that I respect in the business. And I have to tell you, we just didn't know. And you had to still make certain decisions. Even inaction, lack of action in investing is a decision by itself.
Yeah.
I do want to ask you about your new wonderful book, The Corporate Life Cycle. But before we get started, I ask my guests, if they indulge me, about the early days, about their childhood upbringing and how you think that time shaped you. Maybe also how it shaped your relationship with money and the career path that you chose. However much you want to share.
Yeah. I mean, I grew up in India. I grew up in Chennai, which is in South India, perhaps the most conservative part of India in terms of change coming to it. The India I grew up in doesn't resemble in the least the India you might visit today. It was actually an India that probably had more in common with the India from hundreds of years ago. I mean, TV hadn't come to Chennai when I was growing up. I did not have TV to watch. I read a lot, because there wasn't that much to do. It was a very, very different time and a different place. Is it good? Is it bad? It's just what it is. I mean, you grow up with what you know. It shaped me as a person. I went to school in India. I did my undergraduate in India at Loyola College, which was got a commerce degree. And college in India then, I would be lying if I said was an educational experience. It wasn't. It was really a person standing in front of the room, reading out of a book. And because we could not get textbooks, textbooks were not available. It's not even a question of money. They were not available. The lecture was basically taking down what the person in front was saying. So that was the whole point of the class. I became a really quick transcriber without learning any of the skills of transcription. And I went on to get a graduate degree in India, again because of circumstances. At that time, when you finished your undergraduate college in India, you had 15 years of schooling, and most US universities required 16 years of schooling before you could apply to a graduate school. So I had to do a graduate degree in India at IIM Bangalore, which is still one of the at that time it was the youngest of the Indian institutes of management set up by the government. But I went there, got the equivalent of an MBA, then came to the US in 1979, and talk about culture shock. I left a conservative part of India where TV had just arrived. You got 2 hours of TV every night. Was half of it was a farming show, I think, that nobody watched. The other half were reruns of I Love Lucy and other shows they could get from the US consulate for free. I fly into LA. Talk about culture shock. But I was young. I adapted. And I went to UCLA, got my MBA, and when I went for my MBA, my original objective was to do what people with MBAs do, which is try to get a job in investment banking or consulting so you could make your money back. And it was pure happenstance that in the the second quarter of the second year, I was desperately in need of money. So I agreed to be a teaching assistant for a class. It was an accounting class. I don't even like accounting, but I decided to be a TA for the class. And I remember walking into that class, and 15 minutes into the class, I remember thinking, this is what I was meant to do. I mean, I am not a spiritual person or a particularly religious person, but I call these God shots, which is basically moments when you get this revelation. I don't know where it comes from, saying, this is what you were meant to do. Most of the time, we're too busy to listen. I was lucky that I was listening, and I said, you know what? This is what I was meant to do. So at the end of that session, I walked up to the finance department and I said, I'd like to go for a PhD. And people usually go for PhDs because they want to do research and they want to do academic work. And I remember, the professor who I talked to said, why do you want to go for a PhD? And I said, because I want to teach. And he said, but that's not what a PhD is for. I said, I don't care whether the PhD is for you, but that's what it's for me. And I was very clear from the day I entered the PhD program that I was prepping myself not for a lifetime of research, but a lifetime of teaching. So I got my PhD at UCLA. In the last year of my PhD program, I left and went to UC Berkeley to be a visiting faculty. Visiting faculty is just another word for faculty you abuse by asking them to teach everything that nobody else wants to teach. And in the first year at UC Berkeley, they gave me 6 classes to teach, which is almost unheard of in academia because that's 6 new preps. I'd never taught any of these classes, ranging from a corporate finance class to undergraduates to I think a central banking class to graduates. I had no idea what central banks even did. I learned just enough to teach all 6 classes, and I'm glad I did because it made me a big picture person very early on. Much of finance has become specialized. So if you're in finance, whether you're an academic or a practitioner, you're in a small slice of finance. My experience early on made me understand how the different pieces got connected. I had zero interest in being a specialist. I was going to be a dabbler, a generalist, and I've stayed with that. But I came to teach and I continued teaching. I came to NYU in 1986. And, at that time, you still had to get tenure to continue to teach. So I did just enough research to get tenure. But my end game is always, I want to be a teacher. And the reason I want to be a teacher at university is I get slack. Slack in what sense? You teach 3 classes a year. That is my teaching load. I can afford to spend a lot of time on those classes because I don't teach 12 classes a year. I mean, as a contrast, my wife teaches 5th grade. 5th grade, she works 5 times more than I do. She teaches 7 hours a day. She grades 2 hours a day. And I look at her and say, look, if I did that, I'd burn out. So I started at NYU in 1986. And in the very first year of teaching, I went to the head of my department and I said, I'd like to teach a class on valuation. And they said, don't do it. There isn't enough stuff in valuation to fill a class. And they were absolutely right. There wasn't. But I really wanted to do it. So I started teaching valuation in 1986. This spring, 2024, I taught valuation to an undergraduate class and an MBA class. It was my 58th and 59th semester teaching valuation. So something about this class that's going to encapsulate how I think about valuation. Everything I know about valuation, I've learned in the course of teaching that class. Because you can't teach valuation in the abstract. There's no theory. You got to live in the world you're in. And I was teaching valuation in 2020 when COVID hit. In fact, mid-semester, we went back home. And I had to talk about how to value Boeing in March of 2020 when nobody had any idea whether Boeing would make it through the end of the year.
Right.
So it's how I got to where I did, and along the way I discovered I liked writing. Not like writing books per se, but just writing. It calmed my mind. It allowed me to gather my thoughts. So along the way, I've written a dozen books, none of which I started off as I want to write a book. I wrote, and I got enough material. I said this could become a book. So this book, the book that you have, it started as a blog post probably a decade ago. But along the way, I used that same structure over and over in the context of understanding different kinds of companies. And here we are. It's a book now.
And it's an incredible book. And I have so many questions about what you brought up, but I think will come out throughout the conversation. So let's jump right in. The book is The Corporate Life Cycle, Business Investment and Management Implications. So you and I spoke briefly how we kind of talk about the life cycle of a business, but you give it a much more complete context within this book. So what is a life cycle of a business and why we should pay attention?
It looks very much like a human life cycle, right? The human life cycle is you're born, you grow up, you become a teenager, you're at the peak of your life, then you get middle age, and you get old, and then you go into decline and death. Companies go through the same life cycle. Now, why do human beings need to be aware of where they are in the life cycle? Because you get constant physical and mental reminders of how old you are, right? Including Social Security, mailing you a letter saying you're now ready to collect Social Security. But along the way, you get physical reminders. And the rule for human beings is, as you get older, you got to accept the fact that you are older. Doesn't mean you have to give up on things, but there's some things you cannot do when you're 55 that you could do when you're 25. And if you try, bad things happen to you.
Right.
Companies have the same process. They age. There's nothing good or bad about it, but you have to accept where you are in the aging process and behave differently. Behave differently in terms of how you invest, how you finance yourself, how much you return to investors. Investors looking at companies have to take that into context. If you're buying a middle-aged company, it's unreal to sit there and expect it to grow 30% a year and act like a young company. You don't want it to. So investors need to be aware. If you're managing the company and saying, what kind of skill set do I need to manage a company? Very different if you're looking at a young company as opposed to an older company. So as with human beings, companies need to be aware of the aging process, adapt to it, and try to do their best to extend the aging process, make it work in their favor.
And we'll come back to all the pieces, the financing, the management, which was very eye-opening. Before that, I want to ask you about something that really caught my attention. It stood out to me that the US, as such, is unique. So I'm reading in your book that we have a record number of startups in the US. The public companies are younger, and there's also a higher percentage of younger businesses among the listed companies. I'm hearing younger, newer across the board. Why is that? Is that a good thing, though?
It's a reflection of the process that if you're a young company in the US, you have more access to capital and more potential to exit and stay a company. In contrast, if we look at Europe, young companies are basically, I hate to use this term, they're strangled in the cradle. They basically are not allowed to become, because it is a challenge to the status quo. Has it worked out for the US? The US 20 years ago was about 30% of the market cap of global companies. Today, the US is 48% of the market cap of global companies. 20 years ago, the US looked like it might go the way of Europe. But if you look at European growth versus US growth, US real growth has been higher and more robust than European real growth. It's paid off because, in a sense, the US has moved into the 21st century without kicking and screaming. Europe has stayed in the 20th century. Name me one great tech company that's come out of Europe. I can't. I mean, I can think of a couple that came out of, but it's not developed emerging markets, because if you look at India versus China, India has a lot more startups than China does. Something about the structure of the process that allows young companies to find an outlet and stay independent as companies is what allows these markets to revitalize themselves. One test I usually run when I go to one of the nice things about being a teacher, and that's all I do, I don't consult, I don't do expert witness work, is I travel often to teach valuation classes. I travel to Asia, I travel to Europe, I travel to Latin America. And a few months ago, I was in Brazil, and about 6 or 7 months ago. And I was going to talk about the corporate life cycle. So just out of curiosity, I pulled up the Bovespa, Brazilian Equity Index. I looked at the companies in the index to see where they fell in the life cycle. If you get a chance, check it out.
Mm-hmm.
I mean, almost every company there is an old-time company, Vale, Petrobras, a financial service, a bank that's around. There are no young companies there, which tells me that Brazil might talk the talk about encouraging entrepreneurship and growth, but many of these companies don't break out of the pack. There is no NVIDIA in that pack. That's a sign of health when you can see a company that 20 years ago was a glimmer in terms of market cap and now is a $3 trillion company. Yeah, so I think that the U.S. has benefited from a process that allows young companies to grow and flourish. And it's as much because of public markets as private markets. VCs alone couldn't pull the weight here. It's because they have exits into public markets where people are receptive to investing in young companies without much history, often with business models that are not fully evolved. And that net creates value for the economy.
It's fascinating because it rhymes with human demographics, right? If you look at a kindergarten and if you don't have too many 5-year-olds, don't expect to have too many 20-year-olds or 40-year-olds down the road. And here, as a public market investor managing money for families for the last 20 years, I'm thinking of the opportunities that will become available to me and my clients. So if I can't see too many startups and I can't see two newly listed companies, I can't expect to see down the road investable businesses.
And it's not just being able to start up and be established, being able to scale up. And that's a key part of these companies going from being small, young, small companies to much larger, young, large companies. That's something that's very uniquely U.S., where you can be a young company, you can be a small company. The next thing you look at the same company, it's a young, large company. It's a scaling up as well. And that scaling up often comes by clawing market share away from the establishment. That's why European companies do not want the process to open up. It serves their purposes to, as I said, strangle the babies in the cradle, because it means that if there is innovation, it has to come out of the Siemens and the SAPs of the world. And God help us if all innovation were in the hands of the establishment. Because who wants to come up with a disruption that disrupts your own business?
Very much so. It's a fascinating phenomenon. You need to have this natural flow from young to older and make them available. I want to ask about valuation and looking at the stages of life. And I'll bring up an anecdote. I worked in my early years with a lot of traditional value investors who are all about low PEs. And they would say, well, does it have a PE below 10? And I felt like it's a single dimension way of looking at the world, because reading your book, I immediately thought, well, I have 1,000 more questions if it's a single digit P or not. Well, one thing it tells me is probably it's not growing. Second thing it tells me it's probably cyclical, and on and on and on. There's so many more questions to ask. And for some company, an 8 times PE might be too expensive. For the other company, 20 times PE might be cheap. So I always thought that we're not asking, in those early days working with traditional value investors, all the questions. So I'm thinking about valuation and the life cycle. It's a challenge because we may misjudge where we are in the cycle and be too eager to overpay for the growth that's no longer available.
In fact, one of the questions I ask when I run into old-time value investors, and I run into quite a few of them, I talk at conferences, is I ask them when the last time they actually valued a company was. You know how many value investors have never, ever valued a company? You're saying, what makes them value investors? They use metrics like this: low PE, low price to book. That's not value investing. That's sloppy pricing. It's basically using a pricing metric to decide for you what's cheap or expensive. And you're right. It's not just single dimension. It misses so many other components of what drives value: growth and cash flows and risk, So here's the bottom line, though. If you put in a criteria like that, I will never buy a stock that trades at more than 2 times book value or more than 10 times earnings, I can almost guarantee you that you're going to end up in one section of the life cycle. You know which section that's going to be, right? Not just mature companies, but probably mature to declining companies. You're going to get a lot of value traps in there. They will look cheap and they will get cheaper on you. So sensible value investors have always added other dimensions. So I don't want to tar all old-time value investors. So they'll say, I want a stock with a low PE, but with reasonable growth and low risk. So I don't have a good explanation for the low PE. Now, pricing is about mismatches, but it's still not value investing. To do true value investing, you can't use a metric and come up with cheap stocks. You actually have to value stocks. To value stocks, you know what you have to do? You have to make estimates for the future. And old-time value investors view that as a sign of weakness. Why? Because if you make estimates, you can be wrong. That's a horrifically bad way to approach investing. If you refuse to be wrong, you're cutting yourself off. I mean, buy fixed income securities then. The nature of equities is you're trying to forecast the future, and you'll be wrong 100% of the time. You just hope you're wrong in the right direction rather than the wrong direction. And here's the consolation prize. You don't have to be right to make money. You just have to be less wrong than everybody else. That's my basis for arguing that your best investments as a value investor, as a true value investor, will not be in established companies with long histories. It'll be where it's darkest, where people are uncertain, where they don't know what's coming. That's where your chances of making money are greatest. I just bought Intel 4 weeks ago at $18.80. I bought it because people are uncertain about what will happen to Intel. They've knocked down the price. I think at $18.80, and I valued about $28, I think it's a good investment. The odds are in my favor. Nothing's guaranteed. But the best time to invest is when everybody's running away, when uncertainty is highest. And for whatever reason, we made uncertainty a bad word in value investing. But uncertainty is a feature, not a bug. You can't run away from it. You just have to face up to it.
We'll come back to uncertainty, and it's one of my favorite words because it scares people, but it creates opportunities. I'll just mention that you mentioned a particular stock for the benefit of the audience. It's no recommendation to your own research. I think it's obvious, but I'll still mention it. And you mention a contrarian aspect here, going places where people don't want to go, and that's what creates opportunities. And I agree with you. I think these are the places where we can find something that got mispriced, and people might be too short-term focused or plain uncomfortable with the uncertain outcome, and they don't want to be a part of it. They don't want to wait. They don't see a catalyst. On top of valuation, I'm fascinated with management. So many people say, I'm looking for good management. And reading your book, I thought that this vocabulary just expanded to a whole range of flavors, because good management for what kind of a business? That's the question you ask in the book. Well, if it's a startup, it's a different CEO you need. And if it's a company you manage late in its life, it's a different CEO. Very few people actually talk about it, that good management for different businesses are completely different personalities, skill sets, and people and expectations. Can you talk about it?
You know why we did not talk about it for much of the 20th century? Because time took care of the problem. Henry Ford was the perfect CEO for Ford as a young company. Visionary, eccentric, but that seems to go with visionary as they go together. I mean, he made the automobile a mass market product. The Model T, though, came in one color, black. Why? Because that's what visionaries who are eccentric do. They say, hey, who wants to drive a car that's not black? But he was the perfect CEO for Ford as a startup.
True.
By the time you get to the late 30s, he was outliving his welcome. He was cranky. He was not, but time took care of the problem. He died and somebody else took over the company. So 20th century companies, because they lasted a much longer period, it took them a lot longer to grow. They stayed at the top. The transitions often happened, and you didn't notice that the person coming in was very different from the person who moved on. That's no longer going to be the luxury we have in the 21st century, because it's something I talk about in the book, is how the typical 21st century company has a compressed life cycle. I mean, using tech as an example, I describe tech companies as aging in dog years. The legend is dogs age 7 times faster than human beings. Tech companies scale up incredibly fast. Take Yahoo, founded in 1992, $100 billion company by 1999, 7 years to get from nothing to $100 billion. What took Ford and GE decades to do, Yahoo did in 7 years. Amazing, right? The days at the top lasted exactly 4 years. You can almost time it to the day Google went public, because Yahoo's decline began in 2003 and 4. By 2012, Yahoo was dead as a company. They hired Marissa Mayer trying to get them back from the dead. It's way too late. By 2015, Yahoo, rest in peace, the company was done. 23 years from start to finish. And you can argue that as you look at young technology companies, take a company like Zoom, no matter how optimistic you are about the company, do you really think we're going to be using Zoom 35 years from now? I seriously doubt it. This is a company that essentially used COVID to go into hyper growth, but essentially is a company with, even if you think it's going to be a successful company, is not going to stay at the top for very long, and it's going to decline much more quickly. What that'll effectively mean is a CEO is a hero today, could become a zero 10 years from now. Happened at BlackBerry in real time, right? BlackBerry founded in the 1990s, amazing entrepreneurs pushed the company to becoming the dominant, I won't say smartphone company, but phones that we carried around. But over the following decade, the entire franchise melted away with the same people at the top, doing exactly what they did when it was a young growth company, when you need a different set of skills. The way this will play out is you're going to see a lot more friction on corporate governance.
Right.
Why? Because you're going to see CEOs who are viewed as heroes suddenly do things that you said, that doesn't make sense. You're going to try to get them out, and here's the problem. At exactly the time we need corporate governance the most, we've de-weaponized ourselves as investors by giving up power. In what sense? Since 2004, and I blame Google for opening the store, U.S. companies have increasingly adopted, two classes of shares. We have voting shares with high voting rights and low voting rights. And that's how Mark Zuckerberg, with 13% of Facebook shares, can control 57% of its voting rights. I am afraid that we have actually allowed companies to become founder-run. And that might be okay when they're young growth companies, but that might not be okay if that founder is not the right person for the company 10, 20, 30 years down the road.
It's such an important point because so many investors feel so good that the founder is still at the helm. And I think you made such a good point, number of them, so many case studies over the last 100 some years, that the founder was there at the right time for the right reasons. It might not be the right CEO for the later stages of the business. And the other point you made, the life speeds up in the sense the dog years. I like that way to compare it because the cycle from very sudden quick growth to a very quick decline, it's so staggering, so visible, and so challenging for any investor, including the public market investor, because the shelf life of a business, it's a lot shorter. And actually, the DCFs and the perpetuity that we assume might be wishful thinking.
It's not just the top management. It creates whiplash all the way around, right? I mean, imagine being an employee at one of these young growth firms. How do you get your compensation? You get in the form of equity, right?
Right.
You feel great as it scales up from 3 billion to 100 billion. You're now suddenly rich beyond your wildest dreams. My advice to you is you got to start to learn when to cash out, because if you stay with that company, you're going to write it all the way down. So Yahoo employee who got long-term options in 2006 or 2005 who did not cash out ended up with those options being worth a fraction of what they were at their peak. It's not just management. Across the board, it creates whiplash. It's not comfortable. I mean, these are companies, and that's, in fact, last week I wrote a piece on, the Department of Justice has targeted Alphabet for a breakup because of the antitrust laws.
Right.
And one of my counters was, these are not the kinds of companies we have to worry about them getting so big that they're going to act like monopolies. Because monopolies do monopoly things, which is they abuse their customers, they charge sky-high prices. These companies can't afford to do it. They're always looking over their shoulder. I guarantee you that at the big tech companies, they're not sitting pretty saying, oh, things are great. They're saying, what's coming after us? Because that's the nature of these businesses. You cannot afford to sit on your laurels because somebody's coming after you. So it does have consequences for what kind of behavior you should see in these companies, even as they get to be dominant companies.
I love that. I want to ask you about family-owned businesses, but before that, we were talking about valuation management, and the big piece of the puzzle is ownership. And reading your book, I realized how important it is to acknowledge that the ownership of those businesses also changes throughout its life. And you mentioned founders at the beginning. You might have the founders and the VC funds that VC funds probably want to leave at some point. And then you have insiders, and eventually you have institutional investors that come in. And these days it's also ETFs and index funds, passive investing. But you have this rotation in and out. Can you talk about that throughout the life cycle?
Yeah. Because people want different things, right? We all call ourselves investors, but what we want out of our investments can be very different things. If you're an older investor, you might want dividends because you need the cash flows for your day-to-day affairs. If you're younger, you're making a high income, you say, look, I don't want dividends. They just create tax consequences. I want growth. And a VC is basically putting their bids in before any of these companies, their prices. They essentially want to time their entry right, exit right. Very different motives who are all in the game. One of the things I talk about in the book is how a company needs to find an investor base that matches where they are in the life cycle. Let me explain. You're a young growth company. You don't want old investors and pension funds holding your stock because they're impatient. They want to say, when will our dividends start? You want young investors who want growth and appreciation. Conversely, if you're a mature company with lots of cash flows, you don't want people investing in your company who expect you to grow 20% a year, 25% a year. You can't do it. And it's interesting because companies can affect their investor bases. I'll give you an example. This year, Facebook and Google, and I'm going to go with their old names rather than Meta and Alphabet because I feel more comfortable with their old names, did something that I thought was extraordinary. They started paying dividends. And people said, why would they do that? It's not a big dividend, but it's still, it's like the day you wake up in the human life cycle and you say, I can't wear toned jeans anymore. I'm going to wear khakis. Why? Because I've got to go to work. I'm grown up. When you pay dividends, you're sending a signal to the market, right? And the signal you're sending is, guys, we're grown-up companies. We're not young growth companies. Don't buy us expecting 20% growth or 25% growth. We cannot deliver it. I think it was a very good move because it basically lays the foundation for the investor base shifting. Because there will be people who will leave Google and Facebook saying, that's not the kind of company I want in my portfolio. I want growth companies, price appreciation. You're going to get a different investor group coming in. And that's healthy. It's healthy because the company is recognizing where it is in the life cycle and it's trying to attract an investor base that's okay with that, what it has to do given that.
It's fascinating because you could almost pull up the filing and see who owns the business. And with some level of accuracy, you could tell how old the company is. If there are no founders involved, this business has been around for a while, right? That's one telltale.
That's usually the case. And actually staying on the topic of founders are essential to a capitalist system. They create the energy in the system. At the same time, we need to stop worshiping founders. Founders are human beings. They come with their flaws, their good stuff. I mean, look at Elon Musk and Tesla. We can talk about the package you get, but you're getting a package. So when I hear people buy Tesla and complain about what Elon's doing, I say, look, you got the package, you got the good stuff, but you're also going to get the bad stuff.
Right.
But here's what happens at a healthy company. Founders find a way, good founders find a way to make themselves dispensable. I mean, I don't like Microsoft as a product because I'm an Apple user, but I have a lot of respect for what Bill Gates did at Microsoft because he built the company, and while he was still a very young man, he walked out of the company and said, and he's never looked back and tried to interfere in the company. He said, this company is now big enough to live on its own. You see Jeff Bezos in Speedos on some yacht in France. You got to say, this guy did the right thing. He walked away from Amazon and Amazon continues the company. So in a sense, founders separate themselves from companies because you want to build a company that outlasts you. That is the nature of great businesses. And it doesn't happen by accident. It happens because you trust people to make decisions for you. You pick people that you can turn the company over. You build a team that can outlast you. But it's true, as companies age, founders fall off the ranks, but some of them hang around. They don't want, they're like that person you invite to a party who never leaves. The party is over, but they hang around, they stay at your house for the rest of eternity. And founders can outlast their welcomes if they stay around too much.
And sometimes we bring back the founders hoping that they can fix something. And actually, instead of, in the case of Apple, it worked out, which I think is kind of a miracle in corporate history that I know of. But I want to ask you about family businesses. You have this quote in your book, 2 quotes. You say, at first sight, this should imply that publicly traded companies should have longer lifespans than privately owned businesses. But while that may be true in the aggregate, it's worth noting that some of the longest lived businesses in the world are family-owned companies, where the family has developed a structure for smoothly passing the management reins to the next generation. And then you add, it's worth noting that some of the oldest businesses in the world are privately held and often family-owned and trace their lineage back centuries rather than decades. What can we learn from those businesses? How do they reach towards immortality?
You learn that business is full of trade-offs, that you can't have your cake and eat it too. And these very long-lived family businesses have made that trade-off. I mean, one of the reasons I'm very uncomfortable with the word sustainability as it's bandied around now and sold by consultants is consultants to go to companies and say, you can be sustainable and you can scale up. When in fact, scaling up and sustainability, if you define sustainability as building a company that lasts a long time, sometimes that has to come from not scaling up, from staying focused. When you talk about the longest lived companies being family owned, the longest lived company that at least in recorded history, is a company called Kongo Gumi. It's Japanese family owned business. And you know what its business was? Building and maintaining Japanese shrines. That was a business in 529 AD when they were founded. You know what its business was 1500 years later? Building and preserving Japanese shrines. They didn't go big. So family businesses that want to survive often learn their limits and say, this is the trade-off we're making. We want a business that will last a really long time. And that might mean not going after businesses that give us growth in the near term, but it does. I mean, like every trade-off, it can work against family businesses. Family businesses might be much too conservative to get into some new businesses because of that feature. So I'm not saying it's good or bad, but if you define long life as your end game, then family businesses, in a sense, give you the prescription for how you can get that long life.
I've been exploring the 2 concepts, survive and thrive. And a lot of investors say you have to survive first, don't lose money. And I agree with that. I think you have to be aware of the risks you accept first before you get excited about the returns, rewards. But I think you can get yourself in a certain corner, a limited space, when you just focus on survival, because it means that you really say no to everything else, as you said, and 1500 years later, you're just maintaining shrines. I mean, it's great that they do it, but that's the only thing they chose to do for that many years.
I mean, I used the corporate life cycle for another reason, which is if you look at a human life cycle, you could do everything right? You can listen to your doctors, you can exercise, you can eat but guess what? You are going to die. I know it's a depressing thought. You are going to die. Maybe you live to be 108 before you die, but you're still going to die. Death is inevitable. And in every, at least in terms of spirituality, what are you told to do? Death is inevitable. Don't fight it. We all fight it still. We fight aging, but eventually we'll all age and die. So this notion of survival being the end game misses the point. You're not going to survive forever. And if you try, all you're going to do is drain resources, not just from your company, but from the economy, trying to keep yourself alive. It's not good for economies for old companies to hang around well beyond their expiration date. But sometimes governments actually encourage them to stay on. And in the process, they're draining resources and energy that could go into the businesses that you need for the economy to revitalize. Remember, a company, a publicly traded company, is a legal entity. That's all it is. There's nothing glorious about Kraft Heinz. If nobody likes the 57 types of ketchup you make and cheese that stays liquid for the rest of eternity, guess what? It's time for you to leave. And I don't want the East India Company still around. It was an incredibly successful company. It's a company built around a narrative of taking an entire country and making the country its subsidiary. It basically made India its subsidiary. Those times are done, and I'm glad they're done. So this notion that we want to hold on to companies just because they've had a long and glorious history can actually be very damaging, not just for the company and its investors, but for the economy and the market.
So the immortality is not the end game. Sometimes it's worth letting those businesses go. And you mentioned in the book that the assets can be reused, and we know that patents can be bought by other companies and also repurposed.
But you know what? I don't blame the companies or the people running them. I blame all of us. We glorify empire builders. We glorify empire builders. By we, I include not just us collectively as people and as investors, but what we teach in business school, what consultants do. I mean, I tell people, look, I've seen lots of movies about empire builders. Corporate Empire, Steve Jobs movie. I've never seen a movie about a CEO who made his company smaller, even though it was the right thing to do. I think we need to celebrate successful managers at declining companies who actually do their job of making the company smaller and essentially dealing with the consequence of decline. That takes a lot more courage and a lot rarer skill set than growing companies. So I think we need to start to restructure how we think about decline for that to be an okay choice for managers to make.
No, I like the sound of it. Let's put our investor hat on for a moment. There's a quote from your book that I really like. You said, separating good companies from bad ones is easy. Determining whether companies are well or badly managed is slightly more complicated. But the biggest challenge is defining which companies are good investments. I'll
use an example to illustrate this, right? If I asked you, is NVIDIA a good company? What's your answer going to be?
Yes.
It's a great company, an amazing company. In fact, I haven't seen a company like this in decades. It's a company where it's got a CEO who seems to have the zeitgeist, who's basically caught the mood of the moment, who finds these great ways to get into new markets ahead of time. I call it my opportunistic chip company, gaming, crypto, now AI. It's an amazing company. Nobody would deny it. Is it a good investment? What's the variable that has to come in to make that judgment?
How much do we pay?
Exactly. It's the price that determines investment. At the wrong price, NVIDIA is a terrible investment. At the right price, Intel is a great investment. If you were to pick a semiconductor chip company today, from a value perspective, my advice is you should buy Intel, not NVIDIA. A year and a half ago, when I looked at the Silicon Valley Bank fiasco, I looked at banks in the U.S. And I looked at JP Morgan and Citi. Hands down, JP Morgan is a much better run company with a much better CEO, return on equity of 18%, does things right. Citi is a much worse managed company. It's earned 3% less than its cost of equity every year now for almost 20 years. But it's a much better investment. So as you look at these things, you've got to make a judgment about, whether it's a good investment or not. So I think that's something that we have to think about as investors. It makes investing much more complicated than corporate finance assessments. Right? So I could give you metrics on what makes for a good company, a bad company much more easily then I can give you, assessments as investors. That's why I do valuation. Valuation is your attempt to bring in all the good stuff and say, how much should I pay for all that good stuff? And then look at the price you're paying.
Makes sense. It goes without saying, any stocks we mention here, do your own research. We're not recommending anything, but
No, actually, I'm glad you brought that up, because one of my advantages is I'm not an investment consultant. I don't manage other people's money. I tell people, look, when I do evaluation, it's for an audience of one. That audience is me. So whenever I say my entire writing about companies is about, I valued Intel, I like Intel, I'm buying Intel. but I don't think you should.
There you go.
Here's what you need to do. I'll give you the spreadsheet I use. You can take my story. You can change the story to make it your story. And I'm serious. I think all investors need to take ownership of their decisions. What does that mean? You shouldn't be buying something because Jim Cramer likes it, or because Goldman Sachs put out a buy recommendation,
True.
or because Warren Buffett bought it. You have to buy something because you like what you bought. And people's defense is, but I don't understand valuation enough. I'm not an investment expert. You don't need to be. Valuation, if you can add, subtract, multiply, and divide, anybody should be able to value companies. If I didn't believe that, I would not be teaching valuation. Valuation is simple. It doesn't mean it's easy. It's simple. The difficult part is you have to be okay being wrong because you're going to forecast the future. That's what makes people uncomfortable. It's not the process of valuation. It's they don't want to be wrong.
I like to say that I want to be the least wrong. That's my aspiration. And
at least over time, right? You don't have to be right every moment of every day. You can be wrong a lot, but across time and across your investments, you hope to be right more often than wrong.
I just don't want to be terribly wrong. Listening to you and reading your book, I was thinking if there's a sweet spot where we have a lower likelihood of failure because of either immaturity or maturity, and it's a proven business. We still have a decent runway ahead of us. We have still promising growth prospects, maybe room for reinvestment at respectable returns back into the business, and we'll see the biggest improvement in cash flows and profitability. Is there a way to carve out the most desirable piece of the life cycle where we would like to be investors? I'm guessing it's, depending on your profile, but there must be a sweet spot.
I'll tell you what that sweet spot. You're probably unlikely to find great investments there, but you'll feel you're going to get what I call comfort investments. You know why we need comfort investments? Because if you have 30 stocks in your portfolio and every one of them is on the edge and there's a lot of uncertainty, it's going to drive you crazy.
True.
For comfort as an investor, you need a heart of your portfolio where you essentially can buy and hold, because these stocks don't get overvalued by 100% or undervalued by 50%. They stay around. I'll give you examples. Over the last 25 or 30 years, I've had stocks like 3M and Nike kind of stay in my portfolio. And they've had bad years and good years, but overall they've been great. I think they've both reached the end of the tether. That comfort zone has ended for different reasons. 3M because they have litigation against them on things that could potentially cost them money. And Nike because their brand name is finally reaching a point of exhaustion. So these are companies which can no longer be comfort investments. But for 20 years, I didn't have to think about them. They did their job. They delivered returns on time. I could focus my attention on the Teslas and the Ubers that are in my portfolio because they need constant care and attention because their values jump around, their price jumps around. I've got to make sure the stock is not going from being undervalued to massively overvalued while it's sitting in my portfolio. But as an investor, you need comfort stocks, and those comfort stocks are likely to be. And that's why I think when you look at the Mag 7, I own all 7. And again, it's not a recommendation. I bought them at very different points in time. I'm going to continue to hold them even if they get overvalued. And I think all of them during the course of the year have become overvalued one point and the other. Because at this point in time, I think they're closer to the Nike and the 3M from 20 years ago than they are to being young, disruptive, difficult companies to value. So I'm glad I have them in the middle of my portfolio, but they're not going to be the ones that deliver 100% returns for me next year or 2 years from now. That's got to come from other choices I make that are more on the edge, closer to being companies where there's a lot of disagreement about where they will go in the future.
I talk a lot with clients about the quality of sleep. When you look at the portfolio, can I sleep well? Can the client sleep well? And it's a certain choice, right? So you could have a handful of companies that you call on the edge that can surprise you the next morning. But I choose to have the majority in stocks that will not negatively surprise me day to day. Obviously, I don't know the future, things can change, but that's where I belong. But I know that there are other pockets of the market that can be more exciting. And
I think that the key to passing the sleep test, I call it the sleep test, which is if you lie at night wondering how your portfolio is doing, you just fail the sleep test.
True.
No, you should be thinking about your kids, your spouse, the birthday party you're going to go to 2 days from now, not what's in your portfolio. The key to me to passing the sleep test is perspective. In psychology, we call it framing. If you frame your choices correctly, you're more likely to pass the sleep test. I'll give you an example. Nike's been in my portfolio since 2018. When I bought Nike, its price was $27, and that was before the split. So that's like a $3 stock if you look at today's. On a day-to-day basis, Nike goes up 10%, can go down 10%. If I frame my thinking of, hey, where's Nike now relative to where it was at its high? I'm going to lose sleep because it looked like I left money on the table. But if I frame my choice of, I paid $2.40 per share, it's right now at $450. What am I complaining about? I should be grateful. It kind of reframes that choice. It's almost like, you're essentially grateful for what the market has given you. Anybody who complains about equity markets, especially U.S. equities now, and they've been in the market for 15 years, what the heck are you complaining about? You've ridden one of the great equity bull markets of all time. When remember at the start of 2009, there were 3 digits on the S&P 500.
I remember.
Right? It's gone up. The index has become a 10-bagger almost. Complaining about what your stocks have done in the last 3 months strikes me as not just, unreal, but ungrateful. And when you're ungrateful, you start to beat yourself up. You're not going to pass the sleep test. So perhaps passing the sleep test says, hey, what did my portfolio look like 5 years ago? What does it look like today? And then go back and complain about what stocks have done in the last 2 months, the last 3 months. I think framing our choices better will give us a better chance of passing the sleep test.
I really like that the clients I work with have an open-ended investment horizon, and we think in terms of 5, 10, 20, sometimes even 100 years. And it's nice to look back at the account and think that this was this much and it doubled that many times over the following decades. It gives you a lot of respect for true compounding and time horizon. Was it an easy path? No, there were moments when we had a lot of stress, but the point is...
And keep that in mind as you listen to what I call the bubblers. You know who the bubblers are, right? They keep telling you the market's in a bubble, and they've been doing it for a long time.
Yes.
And I tell people, look, even if you believe markets are overvalued, that choice of market timing, I'm going to pull my equities out of the market, you got to think seriously about, because if you take the equities out of the market now, even if you're right about the market being overvalued and corrects, the question you got to ask is, when will you come back into equities? I know people who pulled out of equities in 2011 and have never come back. You probably read some of their newsletters, right? They've been talking about a bubble for 10 years or more. One of these days they might be right, but let's face it, the amount of money they've left on the table by staying out of the market for 12 years is going to be far greater than any money they're going to save by not being in the market when the correction hits. It's my biggest reason for not trying to time markets, is precisely that compounding effect and what happens when you decide to sit out the process.
I see investing as a lifelong pursuit. I'm not trying to time it. I just want to own a collection of businesses that make sense to me, and I subscribe to your philosophy. I want to bring back the concept of uncertainty and risk, and there are 2 quotes from your book. One you hinted earlier. You said uncertainty is a feature, not a bug. And it really made me smile, and I want to hear more about it. And then you say, taking on a risk doesn't entitle you to rewards. And I think it's a very important observation, because some people might think, listen, I'm taking more risks. The market or the investment owes me something. It's not exactly the case. Can you frame the 2 for us?
Well, the reason in my classroom, people get sick and tired of me talking about uncertainty being a feature, not a bug. And the reason I bring it up is, you said earlier, uncertainty makes us uncomfortable.
Yes.
It makes us uncomfortable, not just in investing, but in personal life, because we want to know what's coming, right? So when you're uncomfortable, you deal with it in unhealthy ways. Here are the ways in which I see investors and analysts and appraisers deal with uncertainty. The first is denial, which is you say, what uncertainty? You push it behind the curtain. You act like it's not there, right? When people price things instead of valuing them, they use a multiple. You know what the biggest defense is? I'm using a revenue multiple for this company because I can't value the company. There's too much uncertainty. As if using a revenue multiple makes the uncertainty go away. You've just chosen not to look at it. You've denial. The second is outsourcing. What's outsourcing? Because you get uncomfortable dealing with uncertainty, you call in McKinsey. Say, tell me what to do. As if they have some crystal ball. They're just as uncertain. But here's the difference. They will tell you what to do, and if it doesn't work, you can blame them rather than take responsibility. So you got denial, you got outsourcing. The third is, it comes out of behavioral finance, which is you adopt these shortcuts which you think will protect you against uncertainty. These are called mental shortcuts, which effectively means you don't have to deal with it. Right. So what do? You hard-code growth rates into your discounted cash flow valuation. For every company, use the same growth rates because it worked on some subset of companies. This way, you avoid having to deal with uncertainty in an individual company because you've taken that mental shortcut. And there's a final device we all use that's been around as long as human beings have walked the earth. The oldest uncertainty managing devices. You get down on your knees, you look up at the skies, please God, tell me what to do. I used to have very little patience for in India, for instance, you start a business, you got to start at the right time. The sun and the moon and the stars have all got to line up. I now understand why people do it, because for better or worse, we think the gods will take care of it. Therefore, I'll pray to the gods. My point with uncertainty is you're far better off dealing with uncertainty frontally. And I suggest a couple of tools you might have seen in the book. One is, when I value a company, I recognize I could be wrong on every single estimate, but I'll go further. I'll tell you exactly how wrong I think I could be on revenue growth and margins and reinvestment and risk. And then I run what's called a simulation, a statistical tool that allows you to bring your uncertainty into your inputs, and what it yields is output, that is a distribution. Much more realistic way to think about value of a company is, I think the value of my company is 50. And by the way, here's my distribution of value around it. You're saying, how's it going to help me? Investing is distributional. It's not a point estimate. So you want to buy a company because it's undervalued, but you'd like to know what is the chances you could be wrong. And if you say there's no chance I could be wrong, you're completely missing the essence of equity investing. There are no 100% guaranteed risky investments. There's always going to be something. Which brings me to my second point, which is you take risk, you do all of your homework, and I'll add that. You do everything you're supposed to do. You think you should be rewarded for doing all the right things. The world doesn't work that way. It's not that fair. You could do everything right and have nothing to show for it. Your neighbor could pick stocks based on astrological signs and make 100% returns.
True.
And the point I make is, don't let it get to you. Don't get righteous and indignant about markets. And you hear that talk all the time. Markets are so shallow. Investors don't understand what they're doing. Why are you wasting your time worrying about what people are paying for stocks when it's not your money? Let them do what they want. Reserve your indignation for what you do. So I think that when people think they're entitled, they get righteous. When they get righteous and the market doesn't work the way they think it should, they get angry. And when they get angry, they do stupid things like doubling down on their bets and saying, I'm going to show the market who's boss. And anybody who's ever made that statement will recognize sooner or later that the market is always the boss.
The market is always the boss. I love it. I'll be thinking about it a lot. Professor, I could keep you here all day, but I have one last question. I ask my guests about their definition of success. You've had a wonderful career, many books, many students, and you inspired a lot of people that I do know personally that are in this business because of you. So I'm curious about your definition of success. How do you think about it?
In Econ 101, the objective function for an individual is to maximize utility over their lifetime, not maximize wealth. I mean, there are assumptions you can make where utility and wealth are equivalent. For some people, getting richer is going to make them happier. And for them, I say go ahead, go for the most job that will pay you the most. But for most people, utility comes from lots of different things, right? It comes from how well you're doing financially. It also comes from your family, your friends. I think we need to preserve perspective. Just as diversification is the right idea when you're investing, spreading your bets as a human being across all the different things that give you joy, to me, is bringing Finance 101 into your life. I think we sometimes lose perspective of that. We get too unbalanced in our life portfolios. We spend too much time on some aspect of the life portfolio and ignore the others. And I am just as guilty of that. And I have to remind myself when I'm not paying enough attention to things in my life that give me joy that I should be paying. So I probably spend more time with my grandchildren than I do looking at my portfolio, because guess what? They give me a lot more joy than seeing my portfolio increase by another 3 or 5%. So, and I'm not suggesting that that's what will work for you, but you have to take a look inward and think about what gives you joy and nurture those things, because that's what, at the end of your life, you're going to look back and measure up success by how you delivered on those dimensions.
An inner scorecard, I'm hearing.
Exactly.
Professor, thank you so much for today. This was wonderful. I really appreciate the time we had.
Thank you.
You were listening to Talking Billions. We talk about big ideas, big inspirations, big topics. We take on the hardest subject of all, money. But our conversations lead us to an even bigger question: what it means to live a rich life beyond money. If you enjoyed the show, please take a moment and follow, subscribe, rate, and share with friends and family. We rely on word of mouth to promote the show. One click for you means the world to us. Thank you. Until next time, your host, Bogumil Baranowski.